WACC, weighted average cost of capital, is the average rate a company must pay to finance its assets, taking into account the proportion of each financing source: debt, equity, preferred stock. Think of it like the blended interest rate on a mortgage, where part of the loan is at a low fixed rate and part is at a higher variable rate. The overall cost is a weighted mix. The purpose of WACC is to serve as the hurdle rate for investment decisions. Any project that promises a return higher than the WACC should, in theory, add value. The standard formula is WACC equals E over V times RE plus D over V times RD times 1 minus TC plus P over V times RP, where D equals market value of equity, D equals market value of debt, P equals market value of preferred stock, V equals E plus D plus P, total firm value, RE equals cost of equity, RD equals cost of debt pre-tax, RP equals cost of preferred stock, TC equals corporate tax rate. The weights E over V, D over V, P over V must sum to 1, reflecting the firm's capital structure. The weights in the WACC formula are based on market values, not book values, because market values reflect the current opportunity cost to investors. To determine them, follow a 3-step process. Step 1. Find the market value of each component. Equity, multiply the current share price by the number of shares outstanding. Debt, use the market price of each bond or the present value of the debt cash flows at current yields. If bonds trade close to par, book value is a good proxy, otherwise compute present value. Preferred stock, multiply the current price of the preferred share by the number of preferred shares. Step 2. Add them together to get total firm value V. Step 3. Calculate each weight as the component's market value divided by V. Example, a firm has 2 million common shares trading at $25, 500,000 of 8% bonds selling at 98% of face, and 100,000 preferred shares at $30. Equity equals 2 million times $25 equals $50 million. Debt equals 500,000 times 0.98 equals $490,000. Preferred equals 100,000 times $30 equals $3 million. V equals $50 million plus $490,000 plus $3 million equals $53,490,000. Weights: E divided by V equals 0.935, D divided by V equals 0.0092, P divided by V equals 0.056. These percentages will be plugged into the WACC formula. Explanation: the after-tax cost of debt is the effective interest rate that the firm pays, reduced by the tax shield because interest is tax deductible. First, compute the yield to maturity of the outstanding bonds, then adjust for taxes. YTM calculation simplified for a semi-annual bond. YTM approximately equals open bracket C plus open bracket F minus P close bracket divided by N close bracket divided by open bracket F plus P close bracket over 2 close bracket, where C is the semi-annual coupon payment, F is face value, P is price, N is number of periods. Example: a firm issued a $1,000 face value bond, 6% annual coupon paid semi-annually, 5 years to maturity, currently priced at $950. Semi-annual coupon C equals $1,000 times 6% divided by 2 equals $30. N equals 5 years times 2 equals 10 periods. YTM approximately equals open bracket 30 plus open bracket 1,000 minus 950 close bracket divided by 10 close bracket divided by open bracket 1,000 plus 950 close bracket over 2 close bracket. YTM approximately equals open bracket 30 plus 5 close bracket divided by 975 equals 35 divided by 975 equals 0.0359, which is 3.59% per half year, which annualizes to 7.18%. If the corporate tax rate TC equals 30%, the after-tax cost of debt is RD open bracket 1 minus TC close bracket equals 7.18% times open bracket 1 minus 0.30 close bracket equals 5.03%. This is the figure that goes into the WACC equation. The Capital Asset Pricing Model, CAPM, links the expected return on equity, RE, to its systematic risk, beta. The formula, RE equals RF plus beta times RM minus RF, where RF equals risk-free rate, for example 10-year Treasury yield. RM equals expected market return, often the historical average return of a broad index. Beta equals measure of how the firm's stock moves relative to the market. Beta estimation. Obtain the firm's monthly returns and the market index returns for the same period. Run a regression of firm returns on market returns. The slope of the regression line is beta. If a regression is not possible, use industry average beta or a comparable company. Example, assume RF equals 3%. Expected market return RM equals 9%, and the firm's beta equals 1.2. RE equals 3% plus 1.2 times 9% minus 3% equals 3% plus 1.2 times 6% equals 3% plus 7.2% equals 10.2%. Thus, the cost of equity is 10.2%, the rate the company must earn to satisfy its shareholders. A quick analogy, think of beta as a car's sensitivity to road bumps. A car with a high beta sporty suspension feels every bump market move more strongly, demanding a higher rideshare return. Preferred stock is a hybrid between debt and equity. Its cost is usually calculated as the dividend yield because preferred dividends are paid at a fixed rate and are not tax deductible. The formula, RP equals DP divided by P0, where DP equals annual dividend per preferred share. P0 equals current market price per preferred share. Example, a company issues preferred shares with a $5 annual dividend. The shares trade at $45. RP equals $5 divided by $45 equals 0.1111 equals 11.11%. If the firm also has a small flotation cost on issuing new preferred stock, say 2% of price, the adjusted cost becomes RP adjusted equals DP divided by P0 times 1 minus F, where F equals flotation cost fraction. RP adjusted equals $5 divided by $45 times 0.98 equals $5 divided by $44.1 equals 11.34%. This adjusted cost is used in the WACC calculation. Think of preferred stock like a fixed-rate lease. You know exactly how much you will pay each year regardless of how the market moves, so the cost is basically the lease rate dividend yield. Because interest expense reduces taxable income, the after-tax cost of debt is lower than its pre-tax cost. The tax shield is captured by multiplying RD by 1 minus TC in the WACC formula. The intuition is that the government effectively subsidizes debt financing. Mathematical illustration. If a firm borrows $1,000 at a pre-tax rate of 8% and the tax rate is 30%, the annual interest expense is $80. The after-tax cash outflow is $80 times 1 minus 0.30 equals $56. The effective cost is 5.6% per dollar borrowed. Incorporating this into WACC ensures the weighted average reflects the real cost to the firm after tax benefits. A simple analogy, imagine you buy a coffee for $5 but you have a 30% discount coupon. Your actual out-of-pocket cost is $3.50. The discount functions like the tax shield on debt. When computing WACC, apply the same corporate tax rate to all debt components, including convertible bonds and loan facilities. Equity and preferred stock costs are not adjusted for tax because dividends are paid with after-tax earnings. Full WACC with tax. WACC equals E over V times RE plus D over V times RD times 1 minus TC plus P over V times RP. Make sure to use the same TC throughout the calculation. Flotation costs are the fees paid to investment bankers, legal counsel, and accountants when a firm issues new securities. These costs increase the effective cost of the new capital because the firm receives less cash than the face value of the securities. Adjustment method. Treat flotation costs as a reduction in the net proceeds, then compute the cost using the net amount. For debt, RDH equals I divided by P times 1 minus F, where I is annual interest payment, P is principal, and F is flotation cost fraction. For equity, RAH equals D1 divided by P0 times 1 minus F plus G, where D1 is dividend next year and G is growth rate. For preferred stock, RPH equals DP divided by P0 times 1 minus F. Example, a firm wants to issue $10 million of 9% bonds, but the underwriting fee is 2% of the issue size. Net proceeds equal $10 million times 1 minus 0.02 equals $9.8 million. Annual interest equals $10 million times 9% equals $900,000. Pre-tax cost based on net proceeds equals $900,000 divided by $9.8 million equals 9.18%. Slightly higher than the coupon because the firm receives less cash. After-tax cost equals 9.18% times 1 minus TC. Including flotation, adjusted costs in weighted average cost of capital gives a more realistic hurdle rate for projects funded by newly issued capital. Think of flotation costs like the shipping fee you pay when you buy a product online. The price tag is one thing, but the amount you actually receive or can use is lower after the shipping charge. Explanation: sensitivity analysis examines how weighted average cost of capital changes when the capital structure mix shifts. Because each component has a different cost, replacing cheap debt with more expensive equity or vice versa will raise or lower weighted average cost of capital. The step-by-step approach. Number 1. Set a base case, for example 60% equity, 30% debt, 10% preferred, and compute base weighted average cost of capital. Number 2. Vary one component while keeping the total at 100%. For example, increase debt to 40% and reduce equity to 50%. Number 3. Recalculate the weighted average using the same component costs unless the cost changes with leverage. See the cost of equity increases with debt point. Number 4. Plot weighted average cost of capital against debt ratio to see the minimum point, the optimal capital structure. Numerical illustration. Base case cost of equity 10%, cost of debt 5% after tax, cost of preferred 11%. Weights: equity 0.6, debt 0.3, preferred 0.1. Base weighted average cost of capital equals 0.6 times 10% plus 0.3 times 5% plus 0.1 times 11% equals 6% plus 1.5% plus 1.1% equals 8.6%. Now increase debt to 40%, equity drops to 50%, preferred stays 10%. Weighted average cost of capital equals 0.5 times 10% plus 0.4 times 5% plus 0.1 times 11% equals 5% plus 2% plus 1.1% equals 8.1%. Weighted average cost of capital fell because debt is cheaper after tax. However, beyond a certain debt level, the cost of equity rises due to higher financial risk. The net effect can cause weighted average cost of capital to rise again. Analogy: think of mixing hot and cold water to reach a comfortable shower temperature. Adding more cold water, which represents debt, lowers the temperature, which represents weighted average cost of capital at first, but too much cold water makes the shower uncomfortable, and you have to turn up the hot water representing equity cost to compensate, raising the overall temperature. Performing sensitivity analysis helps MBA students answer what would happen to the hurdle rate if we issue more debt, and prepares them for real-world financing decisions. MBA exams often test the ability to compute WACC quickly and accurately. Typical questions present a balance sheet style snapshot with market prices, tax rate, and required component costs. Then ask for the WACC. Common exam formats. Provide share price, number of shares, bond price, face value, coupon, years to maturity, preferred dividend and price, corporate tax rate, risk-free rate, market risk premium, and beta. Ask, compute WACC. Pitfalls to avoid. 1. Using book values instead of market values leads to incorrect weights. 2. Forgetting the tax shield on debt. Many students multiply RD by 1 minus TC incorrectly or omit it entirely. 3. Mixing up pre-tax and after-tax cost of debt. Remember, the after-tax cost goes into the weighted term, not the raw coupon rate. 4. Miscalculating YTM. Using a simple yield coupon over price is only an approximation. Exam problems often require the exact YTM formula or a financial calculator. 5. Leaving out flotation cost adjustments when they are stated. Treat them as a reduction in net proceeds. 6. Incorrect beta usage. Using an industry beta without adjusting for the firm's leverage, or forgetting to unlever or lever when required. 7. Rounding errors. Keep extra decimal places until the final answer. Rounding early can shift the result enough to lose points. Sample exam question. A firm has 1 million shares trading at $20, 200,000 of 6% bonds priced at $95, and 50,000 preferred shares paying $4 dividend each, trading at $30. The corporate tax rate is 35%, risk-free rate 3%, market risk premium 6%, and beta 1.1. Compute WACC. A solution sketch. Equity value equals 1 million times $20 equals $20 million. Weight equals 20 million divided by the sum of 20 million, 190,000, and 1.5 million, approximately 0.91. Debt value equals $200,000 times 0.95 equals $190,000. Weight approximately 0.0086. Preferred value equals 50,000 times $30 equals $1,500,000. Weight approximately 0.067. RD after tax equals 6% times 1 minus 0.35 equals 3.9%. RE equals 3% plus 1.1 times 6% equals 9.6%. RP equals $4 divided by $30 equals 13.33%. WACC equals 0.91 times 9.6% plus 0.0086 times 3.9% plus 0.06, 7 times 13.33%, approximately 8.74%. Practicing such questions and checking each step against the common mistakes list will help students earn full credit.